So you are looking for a safe investment, something steady, something that pays you just for holding it. You find a stock with a juicy 8% dividend yield. It looks perfect, it looks like free money, it looks like the answer to your retirement prayers. You buy it, you feel smart, you feel safe, you are getting paid while you sleep. Then the company announces it is cutting the dividend. The stock plummets, your 8% yield is gone, and so is half of your investment. This is not a hypothetical scenario. This happens to real people every single day. People who think they are being conservative, people who think they are playing it safe, people who fell for the dividend trap. And today, we are going to talk about exactly what that trap is and how to avoid it. We are going to break down the myths, the hidden dangers, and the one thing you absolutely need to check before buying any dividend stock. By the end of this video, you will never look at a high-yield stock the same way again. Let us get into it. Welcome to the channel, where we break down investing concepts in plain, simple talk. No jargon, no complicated formulas, just the truth about how money really works. But first, a quick disclaimer. This is not financial advice. I am not your financial advisor. This is educational content. Always do your own research before making any investment decision. Alright, let us jump right in. Myth number 1. High yield means high returns. Here is the first trap. A lot of people assume that if a stock has a high dividend yield, it must be a great investment. Let me ask you something. If a company is paying you 8% or 10% just to hold its stock, why is the yield so high? The answer might surprise you. The dividend yield is calculated by dividing the annual dividend by the stock price. So if the stock price drops, the yield goes up. A high yield is often a warning sign, not an opportunity. Let us say a stock is trading at $100 and pays a $5 dividend. That is a 5% yield. Now imagine the stock price crashes to $50. The dividend is still $5. Now the yield is 10%. Looks amazing, right? 10% free money. But here is the question you need to ask yourself. Why did the stock price crash? Is the company struggling? Is the business model broken? Is the dividend sustainable? A high yield is often a sign that the market expects the dividend to be cut, and when a company cuts its dividend, the stock price usually drops even more. The trap is chasing yield without understanding the business behind it. Myth number 2. Dividends are free money. This is one of the most dangerous myths in investing. The idea that dividends are just free cash the company gives you for being a shareholder. But that is not how it works. A dividend is not free money, it is a transfer of value. The company takes cash from its balance sheet and gives it to you. That cash comes from somewhere. It comes from the company's profits, which could have been used to grow the business. Here is how you can see this in action. Look at the ex-dividend date. That is the cutoff date for who receives the dividend. If you buy the stock before this date, you get the dividend. If you buy on or after, you do not. And here is the key. On the ex-dividend date, the stock price typically drops by the amount of the dividend. Let us use a simple example. A stock is trading at $100. The company announces a $2 dividend. On the ex-dividend date, the stock price will usually open around $98. Why? Because the company is paying out $2 in cash, so the company is worth $2 less. Before the dividend, you had one share worth $100. After the dividend, you have one share worth $98 and $2 in cash. You still have $100. Dividends feel rewarding. They feel like an income, but they do not automatically make you richer. The real wealth comes from the company growing its earnings and stock price over time. Myth number 3. Dividend stocks are always safe. Now, let us talk about safety. Because this is where the dividend trap really catches people. A lot of people assume that if a company pays a dividend, it must be stable and reliable. They think of blue-chip companies like Coca-Cola or Johnson & Johnson, which have been paying dividends for decades, and those companies are great. They are the exception, not the rule. But not all dividend stocks are safe. In fact, some of the most dangerous investments are companies that pay dividends they cannot afford. Let me give you an example. There was a famous energy company called Enron. Before it collapsed, Enron was paying a dividend. It looked stable. It looked safe. Investors bought it for the income. We all know what happened next. Enron went bankrupt. The stock went to zero. The dividend was gone. The investors lost everything. And Enron is not the only example. Companies in declining industries often pay high dividends to attract investors. They are trying to make themselves look attractive before the business collapses. The real trap. Dividend cuts destroy value. Here is the trap that nobody talks about. When a company cuts its dividend, the stock price usually crashes. Why? because dividend investors are often income-focused. They buy the stock specifically for the dividend. When the dividend is cut, they sell. And when they sell, the price drops. And the drop is often bigger than the dividend itself. Let us use a real example. In 2020, many companies cut their dividends during the pandemic. One major energy company cut its dividend by 90%. The stock price dropped over 50% in a single day. Investors who bought for the 8% yield suddenly had a 2% yield and a stock that was worth half of what they paid. The dividend trap is real, and it happens to people who think they are being safe, when dividend investing actually makes sense. So, after all of this, you might be thinking, are dividends just a trap? Should I avoid them completely? And the answer is no. Dividend investing is not bad. It is just misunderstood. Dividend investing makes sense in 3 situations. First, if you are in retirement and need regular income. Dividends provide cash flow without having to sell your shares. Second, if you are investing in companies with a long history of dividend growth. These are called dividend aristocrats. Companies like Procter & Gamble, Coca-Cola, and Johnson & Johnson have raised their dividends for over 50 years straight. They are the exception, not the rule. Third, if you are using dividends as part of a balanced portfolio. Dividends can provide stability and reduce volatility, especially during market downturns. But here is the key. You need to look at the payout ratio. This is the percentage of earnings paid out as dividends. A payout ratio above 75% is a warning sign. It means the company is paying out more than it can afford. You also need to look at the balance sheet. Does the company have debt? Does it have enough cash to weather a downturn? Is the business model sustainable? Do not just look at the yield. Look at the whole picture, the final verdict. So, here is the truth about dividend investing. High yields are often a trap. They look safe, but they are not. The companies that pay the highest yields are often the most vulnerable. Dividends are not free money. They are a transfer of value. They do not make you richer by themselves. Dividend stocks are not always safe. A dividend is only as safe as the company paying it. And that is the difference between falling into the trap and building real wealth. That is the dividend trap that looks safe but isn't. The truth, nobody else is telling you. Now, I have a question for you. Have you ever bought a stock for its dividend and regretted it? What was your experience? I want to hear your story. Drop a comment below. I read every single one. And if you know someone who is chasing high yields right now, share this video with them. It might save them from making a very expensive mistake. If this video gave you a new perspective on dividends, do me a favor and hit that like button. Subscribe to the channel and turn on the notification bell. We drop new videos every single week that challenge conventional financial wisdom. Next week, we are diving into something even more controversial. You will not want to miss it. Until then, stay smart, do your research, and never chase yield without understanding the risk.